Picture this. You are finally standing on the threshold of your very first home, keys in hand. Or maybe you're unlocking the doors to that small business you've always dreamed of starting. Now, what's the invisible force that actually made that exact moment possible? Well, it's the cost of money. I am super excited to guide you through today's explainer because we're going to decode a document that honestly sounds incredibly intimidating at first, but is actually the master key to understanding your entire financial world. We're talking about the Federal Reserve's H-15 report, specifically looking at the data released on May 26, 2026. Think of me as your friendly real estate agent, but instead of walking you through a property, I'm going to walk you through the very foundation of how our economy prices borrowing. Our goal here is a true data-to-driveway journey. We're going to take this massive, intimidating wall of government numbers and break it down into manageable, bite-sized pieces so you can see exactly how this data impacts the car in your driveway or the roof over your head.
All right, let's get right into it. Here is our roadmap for today. First, the daily price of money. Second, decoding the H.15 report. Third, the prime loan rate. Fourth, tracking Treasury maturities. And finally, inflation and the future.
Section 1. The daily price of money.
So before we start squinting at specific numbers, we need to establish the big picture macroeconomic landscape. You know, every single day, trillions of dollars move around the globe. And just like the apples at your local grocery store, that money has a fluctuating price tag. Because when you borrow, you're essentially just renting money, right? And the rent is the interest rate. To track that price tag, the Federal Reserve publishes the H-15. Officially titled Selected Interest Rates, this is a report posted every single day, Monday through Friday at exactly 4:15 p.m., like clockwork. Straight from the source text, this report details the yields, or simply put, the cost of various borrowing instruments. Basically, if you want to know what money costs on any given afternoon, whether it's for a commercial bank or the federal government itself, you check the H-15.
Moving on to Section 2. Decoding the H.15 report for May 19th through May 22nd, 2026.
Now, if you pull up the actual document on the Federal Reserve's website, it is a massive, incredibly dense grid of data. But we're going to filter out all that noise and look at a highly strategic slice of this table, specifically focusing on the week leading up to our May 26th release date. What's really fascinating here is how it captures the heartbeat of the economy over just a matter of days. We're comparing Tuesday, May 19th and Friday, May 22nd. Notice the federal funds rate, that is what banks charge each other to borrow money overnight. It is holding perfectly steady at 3.62%. Then we've got the bank prime loan rate, also completely flat at 6.75%, but look closely at the 10-year Treasury, which represents the government's borrowing cost over a decade. It actually dropped from 4.67% down to 4.56% in just a few days. These three foundational metrics, they're the invisible gears turning behind the scenes that constantly influence your everyday borrowing power.
Section 3. The prime loan rate and short-term base rates.
6.75%. Now, if the federal funds rate is the engine room of the central bank, the prime loan rate is the transmission that actually connects government monetary policy directly to Main Street businesses. And for this period, that transmission is running right at 6.75%. Throughout the recorded days in our May 2026 report, the bank prime loan rate held rock steady at this exact figure. And I want to emphasize, this isn't just some abstract economic concept floating around in the ether. This is a very real, tangible number sitting at the absolute center of the commercial banking world. To completely strip away the government jargon, let's look at exactly how the Federal Reserve defines this in footnote 7 of the report. It's the rate posted by a majority of top 25 insured U.S.-chartered commercial banks. Furthermore, prime is one of several base rates used by banks to price short-term business loans. So what does this all mean for us? The crucial takeaway is this. If you're an entrepreneur walking into a local branch looking for short-term capital to, say, buy inventory or expand your storefront, this 6.75% is your baseline reality. It literally sets the floor for your cost of doing business.
Section 4. Tracking the Treasury maturities and explaining yield curves.
We're going to shift our narrative a bit now. We've talked about how commercial banks lend to businesses, but how does the United States government borrow money over different periods of time? This brings us to a really vital economic concept known as the yield curve. If you read the descriptive footnotes of the H-15, you'll hit this very complex-sounding term, Treasury constant maturities. Okay, let's demystify that immediately. The report defines these as market yields interpolated by the U.S. Treasury from the daily yield curve for actively traded securities. Simply put, the Treasury just uses some clever math to smooth out the data. This allows economists to consistently track the cost of a 10-year loan, for example, even if there isn't a specific bond actively trading in the open market that day, with exactly 10 years left until it matures. It's a highly standardized, brilliant way to measure time against money.
And this brilliantly illustrates exactly what that concept looks like in practice. We are looking at a snapshot of the nominal yield curve for May 19, 2026. If the government wants to borrow money for just 1 year, the market demands a 3.83% return. If they want it for 5 years, investors want 4.32%. And for a 10-year commitment, that cost jumps up to 4.67%. You can clearly see that upward progression, right? The longer you tie up your money, the more risk you take on. And naturally, the higher the yield the market demands to compensate for all those unknown variables in the future.
Section 5. Inflation and the future. Let's look at market expectations.
So we've firmly established what money costs today across a bunch of different timelines. But these seemingly dry numbers actually serve as a kind of crystal ball. They reveal the market's hidden expectations about the future cost of living. To see this hidden expectation, we have to contrast two specific types of yields detailed in footnotes 9 and 10 of our report. On one hand, we have nominal yields. These are your standard, actively traded non-inflation indexed issues. On the other hand, we have inflation-indexed yields. These are Treasury inflation-protected securities, very commonly known in the finance world as TIPS. So it's basically the difference between standard fixed-rate borrowing and borrowing where the return is specifically designed to automatically adjust for and hedge against inflation.
Let's put those two metrics head-to-head for a 10-year maturity on May 19th. The nominal yield sits at 4.67%, but the inflation index yield, that one is just 2.18%. Look at that stark gap. That difference is definitely not a coincidence. That spread represents exactly how the collective market is pricing in expected inflation over the next decade. Investors are perfectly willing to accept a much lower base rate of 2.18%, but only if the government promises to also cover the cost of rising inflation on top of it. It's a truly fascinating look into the psychology of the global market.
Well, we have taken this massive, intimidating wall of government data and driven it right back to your driveway. When you see the prime rate holding steady, or that 10-year Treasury fluctuating slightly over a given week, you aren't just looking at math. You are watching the very forces that dictate your future mortgage rates and your business loans, happening in real time. It leaves us with a critical question to ponder as we wrap up today. How might tracking these daily H15 rate shifts change your timing on a major financial decision? Understanding the true cost of money gives you the power to act when the time is absolutely right. Thank you so much for joining me on this explainer. I really hope you feel empowered to use these tools to better navigate your financial future. Keep learning and always keep looking closely at the data.